In this industry, the right partner makes all the difference. 1-800-WATER-DAMAGE is your ally in the restoration space, delivering dependable services and trusted expertise when your customers need it most. From residential to commercial losses, we've got your back. When disaster hits, partner with a team that shows up. Learn more at 1-800-WATER-DAMAGE.com, proud supporters of the Restoration Today podcast. Hey, Restorers, welcome into a fresh episode of the Restoration Today podcast. Again, we are right at the beginning of 2026, and this might be one of the more timely podcasts I've ever done because guess what we're coming into? Tax season. It's everyone's favorite season. Forget winter, forget spring. We are in tax season. You have a little bit, I suppose, before you need to get all that done, but as entrepreneurs and business owners, there are always so many questions surrounding taxes, how to work with your CPA, what you need to know, how to pay yourself, like just so many things surrounding this topic. So I had the opportunity to meet Drew from PNT Advisors at the Trusted Restorer event back in October. And so they're on the podcast today. So I have Drew and JT with me. Drew, I'm going to toss it over to you first to kind of introduce yourself and share a little bit about your background.
Yeah, you got it. Well, thank you, Michelle, for having us first. And yeah, kind of like you mentioned, for anybody listening, if you were at the Trusted Restorer conference back in, what was it, October 2025, a few months ago from when we're recording this, then you would have met me and JT. Both of us were there, and one of our employees. We were the tax guys that had a booth there. So yeah, I mean, thank you guys for seeing us there, talking to us, and Michelle having us today. I will tell you this: I agree that there's only two seasons in the world that matter: is tax season and baseball season. Winter, summer, spring, those don't exist in my mind. What do you mean, no?
We're hockey. No. We're hockey over here. I don't know. I'm in Michigan, so I guess I don't know where you guys are. We're a hockey family, but anyway, I'm just teasing.
That is acceptable. We'll take that. It's actually fun fact for hockey. I learned this from JT. He's more of a fan than I am. It's the one sport where they're called billet parents.
Yes.
Not host parents. I don't know why, but that's something I know. But yeah, JT and I are the two partners at PNT Advisors, and we work with a lot of blue collar people. So whether it's restorers, electricians, plumbers, kind of everybody, I'm sure, subs out to each other at some point or another. So yeah, we do taxes and accounting, or as I like to say, we make it easy for people so they don't have to worry about it. And we work with a lot of people just in the spring once a year, or even throughout the year doing like tax planning and stuff like that. So that's probably a good enough intro to start. And then I guess I'll let JT go. And as we talk taxes more and more, you, Michelle, will answer any questions you have and help people out. Yeah.
Awesome. All right, JT, take it away. And I want to know how you know what billet families are, because you must know some about hockey then.
I know that the state of hockey is Minnesota. I know that.
This is true. Yes, this is true.
Yeah. I played baseball in college, and we play summer ball. So I lived with a host family. And then I did an internship and worked a little bit with a junior hockey team, the USHL. Cedar Rapids Rough Riders are still around. And when I worked there, they called them billet parents. That's how I knew. And I was like, oh, you mean host parents? Yeah, you mean host parents, not billet parents. So that's how I know. I know a little bit about the hockey world, not that much. I know that I guess there's now no more distinction between major juniors in Canada and now Tier 1, because now apparently Canadian or CHL players can play like Gavin McKenna. So I know enough to be dangerous. That's how I say, but I don't know the specifics. That's how I know a little bit about the hockey world. What's a little bit of my own experience.
Okay. The USHL is a great development. Anyway, I won't even start. Keep going. Introduce yourself. Don't get me started on hockey.
After school, I graduated, started working in accounting, and been doing that for, can't believe it's almost been 15 years now, but I've been doing that. Started working for myself about 5 years ago. Yeah, almost 6 years ago now. Brought Drew on. At the beginning of 2023 as a partner, and it's been smooth sailing smooth sailing for me, maybe not for him, but smooth sailing for me. He keeps the ship going in the right direction. That's what I would say.
Okay.
As I like to say from the movie Major League, when Jake Taylor, when they're asking him, oh, you're professional, you guys really, there's a team, and he goes, yeah, we got uniforms and everything. I like to say for us, we're a big boy company. We got employees and everything. I don't know how we did it over the past few years, but we did somehow.
Employees and everything. I get it. Okay, so in the world of this is a lot of small businesses that we're talking about. So there's S-Corps and regular corporations, all the different kind of I feel like this is high level. So let's start high level. how do you kind of coach your clients through whether they should be an S corp or something else? Kind of make those distinctions for us. So, Drew, maybe I'll toss this to you first.
Yeah, great question. Well, it kind of depends on their situation when they come to us, right? Like anything in taxes, it depends. I'll give you a few common scenarios. Let's say, Michelle, you and your restoration company were coming to us. They said, "Hey, Drew and JT, I want you to do our tax returns this spring." We would say, "Great." First, we start with a copy of your previous return. We would see, oh, Michelle's already an S corp, right? Or Michelle's restoration company is already an S corp. In that regard, right, we're going to prep your taxes, and at that point, it kind of comes down to, I guess, tax planning in the fall. Is it depends. If you're already an S corp, well, you've probably got a lot of savings. We're going to talk about maybe payroll, maybe if you have an opening a retirement account, things like that. If you're not an S corp already, great question, no problem. We could do that, but it kind of depends, right? Not everyone should be an S corp, and that's the fun part, at least from my perspective. Whenever you look on like TikTok, Instagram, tax tips, is they always say S corp save you money in taxes. While that is true, there's a lot of admin costs that come with it. So we always tell people, kind of general idea, you want to be making about 100K in profit. Not top line revenue, bottom line profit, about 100K. And then you're going to start benefiting, whether it's because of the self-employment tax or, right, you have to pay an advisor like us or maybe a bookkeeper. So you have a lot more admin costs. You have a separate return. The owner has to be on payroll. Yeah, yeah, I see you shaking your head, exactly.
Might be an S corp over here. Might be an S corp.
Yeah.
Continue.
But yeah, so that's what we always say is about 100K in profit or more. That's the starting point that we suggest anyone to be an S corp. And there are more things that go into it. For example, anybody listening, if you are not an American citizen or not an American resident, you can't own an S corp, right?
Okay.
If you want to take on investors, right? There's a lot of caveats to it, but probably for everybody listening, the most general one is profit. If you're over 100K, probably can benefit you. If you're under 100K in profit, it kind of depends. And what we do with people is we run the numbers before we give them advice on it. We always say, hey, in scenario A, you're going to pay X in taxes. It sucks, but it is what it is. Scenario B, yes, you can be an S corp, save all these taxes. Now you have extra admin costs, extra accounting costs, things like that. So we will always run the numbers and then advise somebody. So hopefully that answers your question. I see you're smiling and shaking your head throughout.
It did
JT,
answer my
anything
question.
I missed, or anything else you'd want to throw in there that would help? Yeah.
You hit it right on the head. You want to be profitable, kind of like Drew said. If you are saving taxes, but when you put an S corp, just a little more admin costs, a separate return, your payroll taxes. Your one thing you want to add in there is the way you deduct your health insurance a little bit different. It's still deductible. It's just one of those dumb nuances that somebody at the IRS said, we're just going to make this harder because why not? And they did. So it's one of those things where, as we always say, the juice has to be worth the squeeze. And S corps have typically found it's somewhere around 100K. For some people, it's a little bit less. For some, it's a little more. It just kind of depends. But you want to be profitable. That's the number one thing I would say.
Well, we all want to be profitable.
One other thing I'll throw in there is anyone, if you're starting a new business, we always advise start as a single member LLC, not an S corp. Or if you have partners, I guess a multi-member LLC partnership, that's fine. But yeah, always start there just because of the extra compliance costs and things like that.
Okay. I don't know if Drew, I don't know if your microphone's rubbing on your collar. I don't know. There's something. It's somebody I think is rubbing. So just be careful when you're talking. I don't know. Oh, I see. Yep. I bet
I'm
that's
move it and hold it. How about that? It was clipped on my shirt. Let me try.
That's exactly what was happening.
I think that was you. Yeah,
Yeah.
I think it was rubbing. It was either your shirt or the headphones.
Because then it would stop, and then you'd move, and it was like, but I didn't see the microphone. I thought it was your head. Anyway, I digress.
Oh, you're good. I know it's a black lapel mic on a black
shirt, which is great.
Fun fact: JT and I actually have a few little things like that we know about, whether it's podcasts like the cough button. Our dad actually worked in sports media. So that, yeah, I know, like they have different color lapel mics for that reason. So it tries to blend in with people's clothes and stuff like that. So, yeah, we try our best. Hopefully it sounds a little better now.
It does. Every once in a while when you move, I think it's still a little brushing, but it's a lot better than it was, for sure.
Okay, cool.
Thank you for doing that. I'm trying to decide where I want to go now, because that was an interesting conversation about the S corp, and I've actually not heard it presented that way before, with the $100,000 in profit and taking it that way. So what are some tips and tricks that you give owners to Oh my gosh, I have multiple questions. I'm going to
You're
divert
good.
really quick. So, you were talking about having a lot in savings, and I've talked to company owners who are like, "We had a really good year, and we have more in savings, and we want to have this for like an emergency fund, but we also don't want to have a ton of taxes taken out of like our emergency savings fund." So, how can you, as a business owner, save in a way that's not going to be totally penalizing you? I'm sure that there's going to be some taxes on it, but what is the best way to save as a business owner if you want to have that emergency fund and don't want to get too penalized for it? JT, you want to take that one first?
Yeah. One of the best ways, or let's first put this out there, because I think a lot of people on TikTok or friends say this a lot. Oh, you could save taxes like there's just like some form. Like, oh, there it is. I just have to sign a form and there it is. That's actually not true. And we actually were talking to a client earlier today about this, was that anytime any tax strategy, whatever it is, whether it's buying a company, whether it's buying trucks or anything, it requires you to spend money.
Mm-hmm.
That could be whether you're paying the IRS, whether you are buying something. Like, money has to leave your account. There's no free lunch. I don't know if you can hear me
Yep.
snapping, but um, in terms of one of the best ways to save taxes, I always tell people is look at things that you're already doing and let's see if we can make those tax deductible or take advantage of things that maybe we weren't knowing. For example, Michelle, I don't. Are you working at home right now?
I am.
Okay,
Yep.
so like that. Um, for all of us, we all have home offices. I know Drew does. I do. My wife, who works for herself, she has a home office. The number one thing that we'd want to do is we want to look at your books and say, especially if you're an S-Corp, is are we paying ourselves for our home office? Are we reimbursing ourselves? And 99 times out of 100 clients, when I look at, I say, hey, like, I'll ask them that, just like you. Are you working from home? Yeah, it is. Okay, I did not see it on a return. So the number one thing we want to do is let's make sure that we are reimbursing ourselves for the home office. Now, that could be as small as $100. That could be $1,000. It really just depends on how much you have to pay your mortgage every month or your rent
Yep.
or whatever it is. So that's the number one thing. We want to turn personal expenses that are inherently business. The next thing we want to do, if you're driving for work, let's make sure that we're either paying that through the business or we're reimbursing ourselves. And a lot of times that is an easy way to find somewhere between, I would say, anywhere between $3,000 and $10,000. Again, it depends on the person, depends on the business. Everybody's situation is a little bit different. That would be the number one thing. That would be the first two things. Second is I would start to look for things that you already want to do. Again, things that you want to do, but maybe you're not doing.
Mm-hmm.
So, for example, some of our businesses that have restores, maybe their kids work with them during the summer. You're probably going to pay your kids an allowance. Right? I see you shaking your head. Yes. If you're going to pay your kids an allowance, that's not tax deductible. But if you pay them to work for you, that is deductible. Now, again, I want to be very clear when I say this. A lot of times on social media here, pay your kids $15,000 just because they happen to share your DNA. That's the wrong way to do it. You want to pay them for actual work. You have to
Yep.
pay them. You have to pay them what you would pay a stranger. So, for example, Michelle, do you have kids?
I do.
One of their chores could maybe be emptying out the trash can in your home office,
Yep.
right? Now, again, you're not going to pay them $15,000 an hour because they happen to have the Blevins last name. That doesn't work. But you would want to pay somebody what you would pay what you would pay a stranger. That's the way I would say it.
Yep.
So if you were going to hire a housekeeper, maybe that's $30 an hour. Well, you could pay right. So something like that. Whether maybe they're going to a job site or the office in the summer. It's the same idea. We have a client. He's he has a tow truck business, but similar. He pays his son. I think
it's 500 a month.
500 a month. I think he's like 14 or 15. So like he works with them on the weekends, a
Yeah.
little bit at night. Right. That's not gonna change the world, but that's $6,000 that he can save, and that's probably gonna save him, $2,000 or $3,000 in taxes right there. So we want to be looking for things that are inherently personal but have a business relationship to them, but we're also following the law. We're also following the letter of the law. We do not want to be doing anything that's illegal. We don't want to be overpaying for something, but we just want to be paying right.
Yep.
So those would be the first things, looking for those personal expenses that are going to lower your taxes. And then next, I would look at other stuff, such as insurance, an HSA account, retirement accounts for you, for your employees. Take advantage of certain tax credits. Like, there are so many ways that we could do that can cut your bill by probably anywhere from $5,000 to $15,000 just right there. And now you found your tax savings that are deductible. You save them, and now you can add it to your emergency fund. Those are the things that I would look at. Looking at personal expenses that are inherently business, and then some of those more advanced ones like HSAs and retirement accounts for the owner and their employees too.
Yeah. And one thing I'll add on there is, yeah, I'm sure you, Michelle, you're hearing this, or anybody listening, you hear like, well, it depends. Well, because it does.
Yeah.
Generally, what we would say is most business owners, especially for like blue collar home restores, most of them have kind of the same 4 or 5, I guess, in the starter pack of tax deductions. Right?
Yep.
There's the home office, there's your cell phone, there's things, especially in home restoration, like vehicles or trucks, cars, things like that. So those are going to be pretty much all the same. Then it kind of depends on the individual and how many owners they have. Do they rent or own their home? Do they? So that's why I say after that kind of first starter pack, which includes like maybe being an S-Corp, after that it just depends. Which is
Yep.
why we always say like at that point, maybe it's us but whoever your tax advisor is, hopefully you're meeting with them at least once in the back half of the year, maybe 2 or 3 other times throughout the year. It just kind of depends, but yeah. And one thing JT, mentioned there, one of our clients who pays his son, yeah, $500 a month. I would say this tax wise, all that's great. And then I don't have kids yet. I hope to in the future, right? I would imagine for you, Michelle, you'll relate to this, or a lot of people listening will, is, you get to bond with your kids.
Yep.
Whether good or bad, they're learning about how taxes work because they're getting
Yep.
a paycheck and money's coming out of theirs, So
Yep.
like they're entering, the big boy or big girl world as well. And they're learning responsibility and kind of things like that. And so those are the things that we look at with clients. It just depends on their situation. But yeah, that's one thing is any advice we give, we're always going to do it based on the numbers, based on, hey, do you have these expenses? Do you work on this? Because that's the only way to make like the best planning and advice for the client. Yeah.
Okay. Perfect. Okay, so you might want to adopt JT's holding the mic. I think because you talk with your hands like I do.
Yeah.
I
Is
think
it still
yeah,
okay?
it's not as bad as it was, but
All right.
it'll just be better, especially because you guys have mics and you know what you're doing. So
Yeah.
let's
Oh,
make
you're
them
good.
sound good.
Yeah.
Okay, I wanted to dig into like specifically some of the credits. For example, JT, you were talking about pay yourself something for the home office. So what's the difference between paying yourself, excuse me, monthly, a certain amount for your home office versus taking a credit or deduction for it in your taxes?
Great question. It depends on the way that you are taxed. For example, if you are an S-Corp, you are supposed to, as the owner, you're supposed to reimburse yourself. You have to cut yourself a check once a month. For all of our clients, we add that through, most of them use Gusto, some use ADP, but they all get reimbursed for that. If you are a sole proprietor or what's called a Schedule C, that's just a form you fill out on the tax return. So it really depends
Okay.
on how you're taxed. Most of the people listening to this are, and that's definitely the ones we met at the conference. I'm going to take a wild guess. Most of them are probably S corps or partnerships,
Mm-hmm.
maybe even C corps. I'm going to
Yep.
say there's very few sole proprietors. I could be wrong, but I'm going to guess there are very few. So most of them should be getting a refund or a reimbursement check. You want to think of, because you're an employee of your business, right? I'm sure you've
Yep.
worked a job before. Like if you drive for work, if you take a client out to lunch, if you take a customer to lunch, that is, you get reimbursed. It's the same thing. You cut yourself a check from the business from, for me, like PNT Advisors cuts a check to JT Pells, to Drew Pells, so on and so forth. So that's the biggest difference, is it really depends on how you're taxed. If you're basically, if you're anything but a sole proprietor, you have to cut yourself a check. If you're a sole proprietor, you just fill it out on your tax form.
Okay. Interesting.
Yeah.
Thank you.
Yeah. Easier said than done, huh?
Learning all the things today.
Good. I'm glad. That's the point. Yeah.
Yeah, that is the point. Okay, so I think another big topic in restoration specifically is, should spouses be an owner on the business as well? What's your take?
JT, you or me
I would-
first?
You
I'll,
first.
I'll answer that.
Okay,
I can
go
go
ahead.
first.
I volunteer as tribute.
Is number one is I always kind of back it up. It actually kind of back to the kids thing. Like if you were going to partner with a stranger, right? Let's assume your wife or husband, it could be both. Let's assume they're a stranger. Would you make them a partner if they did not share your last name or your DNA? Would you make them a partner? If the answer is no, I'm just doing it because I want my wife to be a partner, probably not a good reason. So that's the number one thing, is would you do this if they were not related to you? If yes, then go. Like me and Drew were brothers. Would I make him a partner if he was not my DNA? Yes. Or that sounded a little
I
weird.
think you said
but,
that backwards. I think you said
yeah,
that backwards.
As I said, but yeah, I did not want Drew to be a partner in my business because he simply shared the last name and we grew up together. It was now that is part of it, but it had to do with we can
It's
read
because
each
I'm
other's
so
minds
handsome.
sometimes.
That's really
That
what it is.
too. Is that we can kind of read each other's minds. We play well. His strengths complement my weaknesses. My strengths complement his weaknesses, so on and so forth. So we work well together. That's why it was. It had nothing to do with part of it was last name, but do we work well together? For example, my wife. I'm not going to make her a partner because she's never worked in taxes. She would have no idea what she's doing, and it wouldn't make sense to make her a partner. And then this is the other thing, like any good partnership in a business, like we have it too in our operating agreement, is you want to drop the proverbial divorce paper before the marriage paper. Same thing. God forbid if somebody were to leave the marriage, is that going to impact the business? I would say 99 times out of 100, making your spouse your business partner is not a good move. 99 times out of 100. Now, we do have clients that come in like that, and it's like, well, they've already come in. We're not going to change them. But if you're asking me from the get go, I would say 99 times out of 100 is not a good idea to make your family your business partner. Now, you want to hire them to do some admin work, go for it.
Right.
The reason why I say that is, let's say you have an employee that leaves. That sucks, but you're gonna survive. If you have a business partner that leaves, they can't just walk away. There's tax consequences to it. There's an operating agreement that you may or may not have. It just, to me, I would say it's not a good idea for 99 times out of 100.
Okay.
Yeah, I agree. Generally not. I would go along the same lines when I get asked that question with clients is basically just, is your spouse actually working and helping in the business? Because if they are, then sure. But if they're not, then no. And especially when it comes to liability, right? That's one of the reasons you have an LLC is to separate the business from you.
Yep.
Well, just as an example, heaven forbid, home restoration, something happens and you break somebody's house, you do something wrong when you're trying to fix
Yep.
it. If they sue the business, well, now do you really want your spouse involved? I understand that even if they're not an owner, you come home at the end of the day, you talk about it. I get that. But on paper, do you want them to be legally liable for the business or not is another big consideration. So yeah, it just kind of depends. When we were kids, our dad worked for himself. Our mom, she worked sometimes to help.
Okay.
And it was infrequent, which is totally fine, right? And a lot of our clients, and that's why JT and I like talking about this stuff, is we actually saw it as kids growing up. We may not have realized it. But looking back, we can tell now. But yeah, like our mom used to work with our dad every now and then. We were his little assistants that would go to work, once or twice a week, maybe more during the summer, things like that. So yeah, that's what we would generally say. If your spouse is actually helping, then yes, go for it. And especially, we'll go back, actually, fun fact to being an S-Corp, right? If you are taxed as an S-Corp, you have to be on payroll as the owner.
Yep.
Well, now you have to have two people on payroll, right? So your costs are going to go up that way. So like anything, it just kind of depends on the situation. But yeah, very common question we get. Oh yeah.
Okay, so then let's talk about the how you pay yourself equation. So specifically, let's talk about S corps, and then you can move on from other places. I'm a little selfishly asking here, but there are a lot of S corps in this industry, and I do know that, so it does work out well. I was advised by a restoration company owner who helped me start mine to do an S corp, so that's anyway that. It works out. But what is the best way? Like as an S-Corp, you do have to pay yourself a salary, but then there's also the payouts, and that can help kind of with taxes as well. So as an owner, what is the best way to pay yourself in the various types of businesses?
Yeah. I'll go first on this one. As simple as it sounds, you get a payroll company, Gusto, ADP, et cetera, et cetera. Okay. I understand people realize that. So right, in terms of determining your payroll, well, I guess what would you pay yourself, or what would you pay someone to do your job, like a stranger? Now, there's two ways that we kind of go about this. Number one, and we do this with some clients, it's kind of an optional thing. It's called a reasonable compensation study.
Okay.
Basically, it's for S-Corp owners and other things. But basically, it's like, okay, Michelle, you do these tasks, this many hours. If you wanted a replacement, you would need them to do X, Y, Z. And then it kind of aggregates data from throughout the industry. Here's what a random person would get paid for this. So we do those things for clients. Again, they're optional. Some people like them, some don't. The more informal way is we kind of say, okay, you can afford to pay yourself this much. And we will also ask Michelle for you, if you had to pay all your expenses, like Michelle's life, rent, food, food for the kids,
Yep.
school supplies, entertainment, your car payment, how much do you need every month? And when our client says 6,500, just as an example, then we say, cool, you're going to get paid 6,500 a month. Is it the most official way? No. Does it get us to an end result? Yes.
Yeah.
So that's what we would tell people is, number one, a reasonable compensation report. That is the most surefire IRS approved way. The other is whatever you need to survive every month. That's your take home pay. Live on your salary. And then any excess profits you have, if you want to take a distribution, throughout the year, cool. Like me and JT, right? We're very seasonal. So we take bonuses after tax season. I understand restoration may be a little different than that, but right, yeah, absolutely. So that's what we say is pay yourself enough to live on, and then if you have extra, sure, that's why you do this, right? You don't kill yourself day in day out to not enjoy it.
Yes. I'm not doing this for
Yeah.
free. For our health. No.
Actually, wait, fun fact. I'll throw this in and then JT, over to you. At the conference, I remember somebody was on stage talking about if a client, if you do all the work and a client doesn't want to pay, they say it's too expensive, whatever. You'd be like, what do you say? You're like, well, if you want, I can put all the water back. We can do it that way. I don't know why that came into my mind. I'm sure that reminder that comes from something I just said, but I don't know why that came into my mind. But yes, so that's what we would normally say or kind of advise people on how to pay yourself. JT, I guess what else do you want to throw in?
No, you hit it on the head about how to determine it. The other one is I tell any business, and we do this, make sure you're taking a payroll regular, assuming you can afford it.
Yeah.
If you can afford it, take it regularly. With all of our clients that we have, everybody gets paid the 15th and the 30th, especially if we're managing it. Now, if you don't want us to manage it, that's different, then it's on you. But if we're going to, quote, manage it, me and Drew, we take a paycheck on the 15th of the month and the 31st of the month, every single month. One, it helps you budget your personal life, and it also helps you budget your business, because a lot of times if you're infrequent, it's kind of like anything. If you're very infrequent with what you're doing or not consistent, it's hard to do predictions. The same thing here. So that was the other thing I would add is make sure that you're paying yourself regularly. Now, obviously, at the end of the year, you want to give yourself a bonus. Go for it, absolutely. But make sure that you are paying yourself on a normal schedule. That could be the 1st and the 15th. It could be the 15th and the 30th. It could be once a month. Just make sure that it is the same schedule every single week or every single pay period.
Yeah, and speaking of that, something we see a lot now. I don't know if everybody listening watches as much tax Instagram videos as we do.
Oh, I'm positive. Yeah, that's exactly what I watch daily.
Of course,
hourly.
Come on, Michelle. That's my toilet reading as well, right? Instead of the newspaper, it's Instagram and TikTok videos on taxes. But yeah, paying yourself regularly. One thing, because we get asked this a lot, and I'm sure somebody listening has heard this, is like, oh, well, I'm the owner. I don't want to pay myself right now. I'll just take one big payroll check at the end of the year. I mean, you can, we would never advise that. Like a million things, yes, you can. It's not optimal. So if anyone's thinking that, because we get it a lot, like, well, what if I just do one big paycheck at the end of the year and then, okay. We don't advise that, but we understand, hey, life is life. We're not judging anybody, judgment-free zone. But yeah, it's something that's very common.
I can't even imagine living that way. Like, what? How?
Well, exactly. And that's what we say to people is, I don't know any employees that would say, hey, yeah, boss, you don't got to pay me throughout the year, but just give me a massive salary payment in December. But some people do it. Yeah, we've heard about it. Again, we wouldn't advise it, but we hear about it.
Merry Christmas. Okay, so really quick on this note of, you were talking about taking distributions or salary. Is there a balance that you kind of recommend between the two to make them balance out? Like, is there a tipping point of nope, you should not take 60% of what you make in a year in distributions and 40% of what you make in salary? Like, where's kind of the tipping point of what is good and what is not good?
Yeah, great question. If we want to be legal by the IRS, kind of like you said, it's what you would pay a stranger to do your job. So there is no, oh, well, it should be 60-40, it should be 70-30. That's not the rule. Now, mathematically, where you start to come out ahead, where it makes the most sense, is that if you want, well, 2/7, that's the actual math. That's kind of very hard to do it. It's about a third. So if you could basically a third to a quarter, if you can kind of take about a
Yep.
quarter of all the money that you take out of your business, anywhere from a quarter to a third is salary, 3/4 to two-thirds to 3/4 is distributions. That's where the math starts to make sense, where you become tax advantageous. But again, none of that really matters if that's what your reasonable comp says. For example, if you are a CEO of a restoration business that has franchise locations in 10 states and you manage a team of 1,000, you know what? I'm going to pay myself $30,000.
Probably not.
Like, probably not. You're probably going to have to give yourself a little bit of at least 150, 200K, somewhere in there.
Yeah.
So again, everything kind of is dependent, but generally, if you want to make it to as close to a quarter and a third salary, 2/3 to a 3/4 distributions. That's where the math comes out on top. But
Okay.
again, like I said, it just depends on your situation. Like we met people at the restoration business that had 2 employees, and we met some that had probably 100. So the person who has 100 employees is going to be paid more than the
Yeah.
person who has 2, even if they're doing quote unquote the exact same job, if that makes sense.
Yeah. And actually, speaking of that, I would say there's a very good point you just made, JT. Most of the people that we work with and a lot of the advice we give is for probably restoration or any business, I guess. We would probably say like under 5 million is generally. Now, again, if you're over that, a lot of this probably still applies. Like anything, it depends. But yeah, most people we work with, they're under 5 million. I would say in terms of employees, I think they've all got to be under 20. I know one guy's probably at 10 or 15. I think he's got, 7 trucks, JT? I think Francisco, somewhere in there.
Yeah,
But yeah.
somewhere around there. He's probably
Yeah.
closer to 15, but yeah.
And I say that kind of for context, right? Because a lot of the people listening or the people we met are probably in that range. Maybe there's some outliers on each side. But yeah. So great question. Kind of like JT said. Unfortunately, that one, it's a question we get, which makes sense because taxes are overly confusing, or at least in my opinion, they are.
I think they
But
are,
yeah,
too.
so those are things that we would normally advise people. That's how to do it. Yeah, good question.
It all depends. It depends. It depends. Okay, so before we wrap it up, I want to ask you guys, because you've given a lot of good advice. So, what advice would you give owners that are looking for a CPA? They need somebody to work with. They need somebody that they can trust, that can manage the numbers, that can help them figure out ways to save on taxes in legal, not criminal ways, because that's a big part of it. I once had I once had a friend. We were talking about S-Corps, and she's like, yeah, you got to find a CPA that is just shy of criminal. And I was like, oh,
Wow,
okay.
she's a daring individual.
Yeah, I was like, okay.
We definitely we do the measure twice, cut once approach. We haven't done measure once, cut once. Maybe in the future we will. We're not there yet. We'll say that.
Yeah, I was like, I don't even know what that means, and I'm not even going to ask what that means that you're doing in your
Plausible
life.
deniability, Michelle.
So-
You don't want to know.
Like,
Well,
I don't
it's
want to
actually
know.
funny. It's actually funny you say that. Most people don't realize this. Let's say you do have a CPA that is like super aggressive, like kind of like your friend.
Yeah.
The taxpayer. So Michelle, you're the one signing the return. Even if you come to me and I say, Michelle, let's do all this crazy illegal shit. If you sign it, the IRS is like, well, you signed this under
You did it.
perjury. Most people don't
Yeah.
realize that. So you can't be like, oh, my CPA did it. That's your signature on there. So you're responsible for that. They would have to know. Like it's very rare that happens.
Yeah.
Like Steve Harvey went to jail. Fat Joe went to jail. He's a rapper. Wesley Snipes. Like you could throw their CPA under the bus, which CPA will go to jail, but you're going to sit there right with them. There's never very rarely does a taxpayer get off innocent. It's very rare that
They're right
happens.
with them.
And actually, because
Oh,
of that, we do not make tax payments for people anymore. So, as an example, right, Michelle, you said,
Yep.
like, we did your tax returns. We say, hey, Michelle, you owe, $5,000 to the IRS and $1,000 to Michigan, just as an example. You have to send in that money, not
Yep.
us, for that reason. Because Steve Harvey and other people, I get it's not their fault, but that's why we tell people, like, nope, we're not making tax payments for you. We have done it in the past, but not anymore for that reason. So things to look for. Well, I would say this: a CPA that doesn't want to do illegal stuff. That's the first one. Okay, so
No criminals, thank
actually,
you.
speaking of that, one thing, it's not common. This is a very big red flag. If you're looking for an accountant, if your accountant or CPA will not sign the return. No, Michelle. Like I'll kind of prep it and tell you, but I'm not going to sign it. Just you sign it and send it in. Well, exactly. Yeah, you're confused. Look, well, they
Yeah.
probably won't
Like,
sign
well,
it
you
because they're either
did
yeah,
it.
either they're not licensed or they don't have a PTIN, which is an ID to file taxes. Right? There's something wrong. There's a reason they won't sign it. Just like if as a restorer, if you went to somebody's house, well, no, I'm just gonna tell you how to like restore everything, and I'll just kind of watch, but you gotta like hammer stuff and
Just put the dryer over there at this angle.
Yeah.
It'll be fine. No
yeah,
mold. It's fine.
exactly. So that's one thing is a preparer that will sign the return. In terms of what to look for, I mean, I guess I would say the biggest things are somebody you like and trust. How do you determine that? Well, it's up to you. Um, at least the way that we do it and what most people have kind of enjoyed is that actually before we even get on like a sales call, so to speak, right? We could say discovery call, intro is a sales call. We all know. Before we get on that, we actually require a copy of somebody's last tax return, business and personal, and then access to QuickBooks. And the reason is because now we can talk about your situation, right? Without numbers, we're just guessing and throwing out random ideas. So that's the biggest thing. I guess I don't know if that would fall under maybe like professionalism, maybe. But yeah, so the biggest thing is somebody that does business and personal returns, right? Some tax people will, some won't. It just kind of depends. We do both. We like to look at people's returns and stuff before we send them a quote or give them any advice because we want to make sure that what we're basing it on is based in fact, like or rooted in something.
Yep.
Yeah. The other thing I know a lot of people like this is somebody a little more industry specific. Right? Maybe they understand a little bit better. For example, we actually have somebody who he bought a farm in 2025. Now it's totally cool. We thought he was just living there, and then it turned out he was gonna like sell crops, and we said, hey, like that's totally cool. It's probably not. We're probably not the best guys.
Yeah,
'cause we don't really work.
that's a
with
whole
depletion
different.
yeah, exactly. Right. Right. So that's why it depends. On a lot of people like industry specific things, which makes sense, right? Like take us, we use tax software. We don't, we don't use, or like our project manager tax dome. It's a accountant taxing. We don't use, go high level or something,
Yeah.
So I get it. I would say those are probably some bigger ones. I feel like I'm missing one that's just not coming front of mind for whatever reason.
Maybe JT
what
will
else
get
did you
it.
throw? Yeah, that's what I was like.
Yeah.
JT,
The other
I'm
thing
drowning here. Help
is-
me. What am I missing?
Yeah. The other thing I would say is when you are looking for an accountant or your first one is, and a lot of people don't realize this, and that's okay. There's nothing wrong with that. It's new to most people, especially when you're running a business. You're responsible for your taxes. When you're working, somebody else withhold them, and you just,
You're just
shows up at the end of the year, right? You're along for the ride. Is you want to make sure that you are meeting with your accountant at least twice per year. Obviously, once in February through April to make sure your returns filed, but also once, we always say in the summer months, sometime between Memorial Day and Labor Day. And you want to make sure that you are having that accountant, whoever it is, doing what's called a tax calculation, tax projection, mini tax return, because you want to know in the middle of the year, if the year were to keep going this way, I am going to owe X. How can I get X down to X minus 1 or whatever that number is? A lot of times, most people think, well, I meet with my tax guy in April, and he just, like, that's
his thing.
That's all last year's, right? You have to make sure that you're meeting with your accountant in the middle of the year. And obviously, we do a good job of this, of reaching out to clients in the middle of the year saying, hey, it's about that time. Do you want to meet? Some people ignore us. Some people do schedule time, right?
I
But
don't
at the
want
end
to
of the
talk
day,
about it.
Yeah, or they don't want to talk about it. That too. Is at the end of the day, as a business owner, they're your taxes. So you have to be proactive about it. And you want to make sure that you are reaching out to your accountant in the middle of the year. Again, between Memorial Day and Labor Day tends to be that nice sweet spot because it gives you enough of a sample size to see what you've actually made. And it also gives you time to go out and do things. Maybe you have a big tax bill. Well, hey, have you thought about buying the building you're in or buying a building to store everything in, to have your inventory, because that's that's advanced taxes, but that's a great way to lower your tax liability, is to buy the commercial space that you're in, right? That takes time. So now in the middle of the year, at least now you can start to like, all right, let's get the things together. If you call us December 20th, hey, what do you think? Spray and pray, man. I don't know. You got 10 days left. Oops.
That was very industry specific of you. Nice job.
Yeah. Well, no,
Spray and pray, yeah.
Exactly. Well, yeah, we work with a lot of people in this industry, and actually, as he was going, I was thinking, I'm like, yeah, this will probably stick or land for a lot of people. Is right. A lot of probably a lot of people listening to this. When are clients calling after something went wrong, after something broke?
Yep.
Well, that's kind of like what a lot of clients do with tax advisors is in March. Hey, okay, now it's time to do my returns. Okay, well, okay, but it's just. It's late, like you can't fix anything, right? And when you're meeting throughout the second half of the year, so now we're at the beginning of 2026, right? From July until November, December, like JT was saying, if you message your accountant or call them and say, hey, can we meet and go over this? Yeah, be proactive. That's like your maintenance. That's your, imagine if somebody was calling you to not restore the home, but we kind of work on it. Hey, let's make sure it doesn't break down in advance. Kind of things like the maintenance. So yeah, those are going to be the biggest things for sure.
Perfect. Okay. I love it. This was great advice. I learned a lot actually myself and have some things to go talk to my bookkeeper about when we're done here. And then maybe our CPA. And anyway, this was great. So anything else that either of you want to share before we wrap it up, and where can people find you?
Yeah. No, I mean, first, thank you for having us, Michelle. Appreciate it. And kind of like we said at the beginning, we met you and a lot of great people in Kansas City a few months ago, and we were happy to go and whatnot. So yeah, if there's a tax question that, whether it's for you, Michelle, or anybody listening, if we've been able to get you at least one step closer, by the end of this, then great. Like that's the point. That's the goal. Because we understand taxes can be ridiculous and they don't necessarily have to be, but it is what it is. Write your congressman, I guess. But that's what we, well, actually people will say like, well, why is it that way? Because someone in Congress decided, because I guess tax people don't have the best lobbyists. That's why. Us tax advisors don't have good lobbyists. That's why.
Why are cars deductible? Because Hummer paid a lot of money to make them deductible. I don't know.
Yeah. That's why. Yeah. But yeah, I mean, we are taking on new clients for tax season. So if there is somebody listening that is like, yeah, you know what? I need my first CPA because maybe you finally cracked 50K in revenue. Maybe you finally just hired your first employee, right? And you're like, hey, I got to talk to somebody. Or maybe you're just tired of doing it yourself, You're just like, yeah, I've been doing it for a few years. Enough's enough.
Yep.
Yeah, we are taking on new people. But yeah, the best way to meet with us is to go to our website. And I'm sure the link will be below and everything. PNTadvisors.com is the best way. And you can read all about us. There's a link there to book a call and everything, get to know us. And the other thing, I guess, if somebody wanted to just straight up call us, like our business phone, 515-461-8778. Just call, tell us you heard us on the CNR Magazine podcast, and we'll call you back. Yeah, that's actually the biggest thing we say is if you call us or message us, we'll call you back.
It's actually
a lot of people say
call you back.
Yeah, that's the big. Honestly, that's the biggest complaint we hear from people about. They're like, oh, I can't get a hold of my current advisor. My tax guy never calls me back. Well, we'll call you back. Just as long as you.
If you get a client out of somebody calling you from this podcast, I have got to know. If they don't come through the website, somebody that directly calls you from this podcast, I must know.
Okay, you're on. Yeah, absolutely.
All right,
yeah.
JT.
If you're out there,
yes.
Make it happen.
Yes, that's right.
Make Michelle happy. Don't worry about us.
I can totally see like website form fills, people reaching out to you that way. If somebody actually calls you from that phone number, I've got to know. So, yeah.
Hey, Mike Jones' phone number still works.
Oh, damn. She didn't get it, JT.
Sorry.
There was a rapper. This was in...
Everybody held their breath.
No, we're like, nope, silence. Oh, damn.
Sorry.
This was, maybe mid-2000s, 2005, I want to say. There was a rapper named Mike Jones, 281-330-8004. Like, and it worked. Like, you could call it. It works.
He gave out his real phone number in a rap song. Yeah. Yeah. It was his, yeah. Oh, yeah, I tried calling it in middle school or high school, whatever. Oh, yeah, I tried calling it. It was
Yeah,
one of
it
those
worked.
ones. This number is no longer in service. It was one of those, but oh yeah, it was his real phone number in the beginning. Yep.
Well, I had a friend, like, he picked up, like, because it was when the song first started going, was popular. Like, it was his phone. Like, he picked up. Yeah, it was Mike Joe. Like, yeah, I picked up. And obviously, after a while, he didn't.
Yeah, he was
Who
like, that
called?
was a
Was that
huge
Alex?
mistake. What?
I'm
Well,
pretty sure it was Alex. I remember
It had.
somebody
I
told
knew
me.
it. I was like, that had to
My
have been
friend's
Alex. That's hilarious. I didn't know that.
Yeah, they called, yeah, and it worked. It worked. He picked up the phone.
yeah.
Oh god.
There's a lot of morals to that story. Don't ever put your number in a song. Okay, JT, any final comments? I'm sorry your joke missed me.
No, it's okay. That's right. It happens. Not for everybody. Yeah, like Drew said, we're taking on new clients. We do a pretty good job. That's why clients keep coming back to us. And one of the biggest things that we hear is, man, I've never had such an easy tax season before I met you guys. And that's you're not going to be the first. You're not going to be the last. If you guys are looking for a little bit easier experience, give us a call or go on our website, but preferably give us a call. That's what I would like to hear now. Give us a call and make sure you leave a voicemail. There's so many times people will call and they don't leave a voicemail. Or that number 2, you can actually text that number 2. Leave a voicemail or text. Say, hey, I'm blah, 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 blah.
Yeah,
I would
that
say a
be
text
fine,
message.
too.
That counts as a phone call too. That counts.
Okay. Yes.
counts.
Anybody reaching out to that phone number, it counts.
Yeah.
Yep, exactly.
I like it. Okay, Drew and JT, well, thank you so much for being here. I super appreciate it and all of the advice. I think that you're going to help a lot of business owners through this, so I appreciate it, and I hope you have an awesome rest of your day.
Thank you. Appreciate it, Michelle.
Thank you.
For more Restoration Today and the latest news, visit our website, cnrmagazine.com, and find the latest episodes of the Restoration Today podcast on your favorite podcasting platform.